credit. You heard that?
Yep.
Okay, good. Still can count on one hand the number of non-recorded conversations, trying to keep it that way. Okay, here we go. Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Travis King. Travis is the founder and CEO of Realm, where he is responsible for overseeing all aspects of the organization with a particular focus on culture, strategy, and investments. And in just a minute, we're going to speak with Travis King about long-term benefits of commercial real estate. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, you can leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Travis King. Welcome to CRE PN Radio.
Thanks, Darren. Glad to be here.
I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. Realm is a very unique firm. We're a collective of family offices on typically about 200 million of assets under management each office. So we collectively, our group manages about over $12 billion. Really what we're doing is being able to pool our resources together, not just our collective capital, but also our trusted relationships and our experience in different facets and areas to collectively invest and be better together than any of us would be individually. So it's really a way to be able to have a direct real estate office without having to build your own internal capabilities for each of these firms. So like I said, we've got about 100 members, and it's a very unique way to be able to find access to deal flow across the country that isn't normally going to be seen by most folks otherwise.
Got it. So family offices, exclusively family offices is who you work with?
It is. Yeah. Like I said, we've got some folks that are newer family offices that have maybe just had a liquidity event where they sold the company and now they're looking to, diversify a little bit. And we've got multiple generation family offices as well, where I think our largest might be fourth or fifth generation. We have several of those guys that are multi-billion-dollar family offices that have been around for quite a while. But in our experience, it's the level of sophistication and the needs of those family offices is really, I think, what attracted us to work with them. And we're a family office ourselves, right? I built all of my wealth in real estate, and I think they really appreciate the fact that we're very aligned, and this is all we do, right? We focus on real estate 24/7.
Got it. So with respects to real estate, is it strictly acquisition, liquidation, or are you doing any development, or you get involved in any leasing, or is it strictly you guys are the entity that's acquiring properties?
Yeah, we do a lot. Our scale is enough that because we invest across property types and geographies, our portfolio, if you look at it, spans coast to coast across the United States. We're in probably 20 different markets. And as a result of that, we also do all property types, right? So if you can think of everything from the four food groups, which would include multifamily, retail, office, and industrial, We've done things in student housing and senior living and some of those storage ancillary businesses as well. And we typically are acquirers, but we also do develop occasionally. So I would argue we've got a handful of assets that we have developed. So we will develop when the time is right or there's a particular circumstance that allows for it. But generally, we're looking to find really strong risk-adjusted returns on existing assets where we can take advantage of some seller circumstances, some creative structuring, and find ways to have strong upside potential, consistent, durable cash yield without taking a ton of risk.
Got it. So is this essentially like a syndication exclusively for the members of uh, your group there?
Yeah, not everyone in our group necessarily. It's not, we don't pass the hat around. We've got different vehicles within the firm. We have some folks that are dedicated vehicles that folks participate in. We do have some things where folks want to participate on a deal by deal. They've got the ability to do that. Really is a function of what deals we're finding. A lot of times we'll have a deal, for example, that's going to exceed the threshold at which we want to invest out of one of our vehicles. So we might open that up to folks on a case by case basis. So it gives people the flexibility. And we found as we've built the firm, this strategy over the last 15 years or so, we've realized that the adage that if you've met one family office, you've met one family office is true. They are each very unique and have their own set of needs and circumstances. So what we try to do is provide as much flexibility as we can there. And I think that's reflected in the different types of investment vehicles that we have.
Got it. So the direct investment, are you are you sourcing the deal directly with the seller, or are you using brokers, or how is that
Yeah,
happening?
we definitely we won't shy away from working with brokers, but I would argue the majority of the deals that we find come from one of two strategies. They're typically going to be sourced by operating partners. We do work pretty extensively with operating partners all across the country. What we found is that by being able to be a trusted capital partner for those operators, we're able to find deals that otherwise most folks wouldn't see. And again, we operate primarily in the lower middle market, kind of defined as assets that are 50 million and below. And as a result, that tends to give us a little bit of an advantage from uh, being able to structure, level of sophistication, access to capital, and some of those things to get a little bit better returns than maybe we might otherwise. So that's a big part of what we do. And I would say the other half are probably us being sourced directly, sometimes with the involvement of a broker, sometimes not. We typically don't participate in a typical marketed process, though we're very infrequently going to be the ones that are going to just pay the most in a marketed process. We usually want to have some type of an advantage that makes us feel like we've got some knowledge or something that we know or understand about a particular transaction that makes it more uh, apt for us to do that deal than somebody else.
When you said operating partner, what does that
Yeah.
mean?
An operating partner means somebody who's doing something very specific at the property level, right? You hear the adage that real estate is local, and it very much is. And so I'll give you an example. An operating partner might be somebody who is a leasing specialist, for example, and has bought several properties on their own in a particular market. And they come across a property where they know that those leases are under market. They've got a relationship with the seller. They've been talking to him for years. It's finally gotten to be the time where that seller wants to sell. They're buying the property off market. They know that the leases could probably be 50% higher than they currently are, but they need, $12 million to be able to buy that property in fairly short order. They'll come to us and we'll work together to go through and be able to buy that property so that they can go through and execute. And they, in essence, act as an extension of our team. They're going to do what they do best, which is being on the front lines, doing the leasing, helping to acquire that, working with the seller. And we act in the background to supplement that as needed, depending on wherever the skill sets lie. So again, we're pretty flexible there. It depends, much like family offices, operating partners are each pretty unique and different. We work from everything from one-man bands to 60-person shops, so it can run the gamut. And our goal is to take our scale and capabilities as a nationwide firm that does billions of dollars of real estate and help where we best are suited to do so.
Got it. So is the strategy then, or are you guys you're coming in obviously as capital, but are you coming in all cash, or do you structure the deals where you're down payment and you borrow, or how's that work?
Yeah, that's a great question. We will use debt. Depends on the situation. We're not real big users of leverage overall. I would say to date, our portfolio is probably 35% levered, which is very low. Um, Look, at the end of the day, most of our investors are investing capital they don't want to lose. That's the primary goal, right? These folks typically have enough capital. It's not about trying to maximize every last dollar of absolute gain. I think I'm of the same mindset. So a lot of times we're looking at it and saying if we're buying a property that makes a lot of sense, you really are making your money on the buy. It's really the price that you're paying for that property up front and the structure that you incorporate. Leverage should be a nice add-on to that, but it shouldn't be what makes or breaks a deal. So as a result, we feel like most of our deals should stand on their own on an unlevered basis. And then, like I said, we'll use leverage selectively. But that's a key metric for us is really looking at that unleveraged return. If I don't like the unleveraged return, I'm not going to all of a sudden like a deal more because I can put leverage on it in most instances.
Right. So hold time, what kind of strategy do you guys use as far as hold time, or is it a
Yeah.
hold forever?
No, that's a great question. It depends on the strategy. I would say our flagship strategy has been an opportunistic strategy where we're trying to find properties where we can, at a high level, double our money in 3 to 5 years. So that's one strategy. I would say we have another strategy that's more focused on durable yield, which is trying to find properties that are going to have safe, consistent cash flow that shows up regularly, without taking tons of credit risk on the tenant. Those can be longer holds. We found that, when you get that mailbox money and those are coming in regularly, we tend to hold those longer. So I would say those can be 5 to 10 or even more years on the hold period. And then the other thing I should mention is we do quite a bit of work with our investors on 1031 exchanges. And that's one of the things that over the years we built a very strong practice in doing. And we're able to take, properties where someone's selling and has a large chunk of capital that's allocated in a particular property and geography and help diversify that across property types in multiple geographies to really diversify their risk. And we can kind of fine tune those things, right? Between looking at saying, well, hey, let's do some things that are going to be a shorter term hold and maybe more equity multiple related. And let's do some other things that are maybe more cash flow generating longer term holds. So again, we're kind of playing with those levers all the time between the duration of the hold, are we trying to get equity multiple or are we focused on yield? Those are kind of the big levers that we're looking at on any given investment.
So in the exchange options, are you would that be a singular uh, client that's investing, or are you able to do multiple investors in a property, including someone who's exchanging out of one?
Yeah, we've done both. And again, it goes back to the circumstances of the individual. But I would say that, we've done multiple exchanges that have been, upwards of $30 million where those have come out of one property and gone into two or three or four properties. In some cases, they're still individually held 100% by the person that's exchanging. Sometimes those will go into maybe as a tick or something like that into another deal. Again, we really start off with the objectives of the investor who's exchanging and try to make sure that we can accomplish a real bespoke outcome for them of what they're trying to achieve. And we feel like, that takes a lot of time and effort, but our scale enables us to be able to do that because when you've got an exchange, you're on the clock, right? You've got to know that you can land the plane on some of these investments. So the fact that, at any given time, we're looking at properties all across the country really gives us a leg up in that regard.
Got it. And as far as um, the four food groups you mentioned that you guys invest in, is there any kind of key metrics that you're looking for? I mean, you mentioned dollar size under 50 million, but is there like an age of property, or is it more about just the numbers that you see an upside?
Yeah, that's a good question as well. No, there's not a magic number. I would argue that we're trying to find value, right? And value comes in a lot of different ways. So, and there's also things that happen depending on the vintage of a property when it was built that you start to think about. So just this morning, I was looking at a property that's a 70s vintage in Florida. As soon as you hear 70s vintage, you start thinking, okay, well, I've got to make sure am I looking at flat roofs? Do I have to think about asbestos? Do I have to think about a whole litany of things that come up based on when a property was built? So there's definitely things you want to add on your checklist, right, as you're looking at these properties if you're dealing with an older vintage. But sometimes, the flip side of that coin is that there have been a lot of people that were buying 70s vintage properties in Florida that were trying to capitalize these primarily by passing the hat, like you said, and syndicating those that didn't have particularly strong balance sheets that have run into tough times. So that might be a great opportunity. And what you have to balance is how it is the attractiveness of the price at which you're able to purchase that property reflect the offsetting risk that comes with buying something that might be an older, 1960s or 1970s vintage product. There's things like that that we're trading off all the time. So it's hard to focus on any one specific number because I feel like there's a lot of variables there. But there are definitely some rules of thumb and some things that you want to look at along the way, depending on what property type and what geography you're buying in.
Got it. So you mentioned Florida. Is there any specific territory that you guys try and or have you focused on lately?
Yeah, we've traditionally had a very strong presence on the West Coast. I think we moved our firm headquarters from San Diego to Nashville almost 5 years ago now, and I think part of that is just we continue to invest pretty significantly in California, but I think there's a pressure to move away from California. I think a lot of investors are seeing the growth that's coming in the Carolinas, in the Texas Triangle, and some of the parts of Florida. Um, I think the commonality between most of those markets is that they're pretty strongly pro-business, and they've got a good quality of life, and people are moving there. So there's no rocket science to that, but I think if you can find areas where there's abundant jobs and people are moving there and want to be there, that's a good place to be. And again, we're trying to be where the puck is going in that regard, but we're also not trying to find, the next Nashville or the next Austin so much. We don't want to be early. I think we just want to be consistent. There are markets too that we look at that maybe aren't nearly as dynamic, right? So there's some markets. I'll give you an example. Madison, Wisconsin. We've got a property there. Madison is an area where it's got very actually tight supply demand dynamics, right? It's actually pretty difficult to build and develop in that area, but you've got very strong demand drivers, which makes for very attractive if you can find the right properties in areas like that. So that's something to keep in mind. So we're always trying to look at supply demand dynamics within those individual markets. But I would say the main spots we're probably most interested in are that Texas Triangle, the Carolinas, some parts of the Front Range in Colorado, Salt Lake City. We like those areas. Some of those markets don't have a lot of velocity transaction wise, so you've got to pick and choose pretty carefully. But the areas that you hear that are growing are pretty much the areas that we're really looking to grow in ourselves.
Got it. And for those, do you have relations? I mean, you've talked about these operating partners and that. Is it a matter of that they've learned to seek you out for capital, or is it the reverse in that you've identified markets you'd like to be in and have looked for operating partners?
Yeah, it's a little of both. I would argue a lot of these folks we've had trusted relationships with for decades in some cases. And what happens is that trust transfer happens because the markets inherently are pretty small at the end of the day. And I would say the majority of the folks that we do business with are referred to us. That happens. That's the case for both our investors and our operating partners. And at the end of the game, trusted relationships is everything. The folks that have worked with Realm over the years that know our principles know that we're highly principled folks and that integrity is the most important thing to us. I mean, that's important, right? Because a lot of times you're going to have individuals in the form of operating partners that might be bringing you a deal, and they might be folks that only finding this, one or two of these, every year, every other year, every 5 years, right? So sometimes this is a very big deal for them. And if they've got a choice between bringing it to a traditional private equity firm versus being able to bring someone who's very principled and focused on long-term relationships versus transactions, that goes a long way and makes a big difference with folks.
Got it. So within your clients in the realm, a little curious more about how the deals actually come together. I understand somebody bringing an opportunity to you, but within the potential investors that you represent, uh, is it you basically have a bucket to fill and you're looking for you just kind of run it through the channel there to see who's interested, or are there people that they pre-identify what we'd like to be in, or how's that work?
Yeah, again, that one's it's a bit of both. We definitely have pre-identified capital that's ready to go, so that we can move quickly on opportunities and know that we're going to have capital available. But we also have folks. We're in constant communication with all of our investors, so we've got a pretty good sense of what folks' liquidity looks like and what their appetite looks like. So some of those folks are going into anything that we are finding that's interesting. Some folks are going to be like I talked about on the exchange side, might be folks that are looking for something very specific, right? And so we're going out trying to find just that one specific thing that they're looking for. And again, I think that's part of the benefit of the scale that we bring, being a nationwide real estate firm that's only doing real estate and that is very active. I think we've either closed or will be about to close about 5 properties here just over the summer. So, I mean, we're very active, especially at a time when I think most of the market is pretty much down significantly in transaction volume. We're a very active group, so that enables us to do that. But there's no one. There's no. We want to make sure that we can close deals when on at any given day, but we also want to make sure we've got capacity to adjust for. One of my investors just closed a deal. He's got $30 million of liquidity. He's not going to want to put all that out into one deal, but he does want to be able to get it invested and get put to work fairly quickly. So again, that might be the kind of thing where we'll supplement that alongside some of our other vehicles.
Got it. And so when all of the investors come together, is it a TIC, or do you create an entity and everybody has percentages, or how's that work?
Yep. We use ticks a lot of times on exchanges where there's a need to make sure that they're operating together, and we can use ticks on a select basis on one-off investments depending on what we're investing in. Generally, we tend to have other vehicles that are investing, and sometimes those vehicles will come together as ticks as well, right? So we do at times if I've got 3 different vehicles that are investing together, they might all be multi-investor vehicles, but those 2 or 3 vehicles might invest collectively into a particular transaction, in which case sometimes we'll put those together in, they'll just be 2 members of a partnership, or sometimes they'll actually be distinct ticks depending on the nature of the underlying transaction.
Got it. You mentioned earlier kind of the goal in the opportunities you're finding is to double the I guess the profit, or double the equity within
Yep.
2 to 3 years. Um, that's I mean, you're finding some great deals if you're, able to do that. My question would be more about how do your investors view real estate with respects to the long-term benefit of commercial real estate?
Sure. No, that's a great question. Look, if you look at most families that have created significant wealth over the long term, you would be hard pressed to find families that don't have real estate in some central part of that strategy. So I think that long-term real estate is widely viewed as an important lever for long-term growth and wealth. And I think that comes from a number of fronts. There's obviously a benefit to real estate from a tax perspective, right? You've got the benefits of depreciation that are very helpful. I think it helps preserve your spending capital and the spending power of the dollar, right, in an inflationary environment. So if you look at like the time we've been in where we've had billions of dollars that have been printed and the value of the dollar gets under question, it really helps to be able to have properties where you can adjust those rents on a sometimes monthly or yearly basis, and be able to capture that appreciation as you grow. That can be very beneficial for groups. So again, if you look back long enough and you compound at a nice consistent rate, the reason that Warren Buffett is as wealthy as he is because he's been compounding at a very high level for a very long period of time. And that's not magic. But I think that real estate does 2 things in that regard as well or better than many other investments. Number one, it allows you to invest more dollars on an after-tax basis because you're able to, in some cases, defer or offset tax through depreciation and other things. And the second thing you're able to do is benefit from regular increases in your rents whether it's multifamily and you're adjusting rents on a monthly basis with a dynamic pricing model, or whether you've got a built-in lease from a corporate tenant, right? That's got 3% bumps built in over a 5-year period, for example. The benefit of that compounding means that traditionally real estate will continue to increase, right? And I think that if you can do that in a very conservative fashion and you don't over leverage, it can also be a very safe way to be able to grow wealth because it also has the benefit of generating ongoing cash flow, which again can have a significant shield from tax if it's structured properly, and that can further compound that growth at the same time. So that's why I think real estate long term people continue to look at it and enjoy it. It's also tangible, right? At the end of the day, people love the fact that, hey, I can drive by, I can look at it, I walk inside. I think one of the things our investors love most is that when we're bringing them investments, we're not a black box. We're not like, hey, give us your money and we'll tell you how you did in 5 to 10 years. They understand the strategy. They understand what we're buying. They understand why we're passionate about what we're buying because you can understand the tenants and the nature of where the property is located. And I think that's what people really enjoy. And there's that tangible nature makes real estate, I think, unique in that regard that you can look, feel, see, and touch it.
So, from a return standpoint, I mean, doubling your money in 2 to 3 years, that's obviously a home run, I would think. Is there uh, a different measure when you're looking at more of a long term, like a one that's like you said, mailbox money that just keeps showing up? Is there a rate that your investors expect that's conservative, but not like just a CD rate that they would expect in something like that?
Yeah, I would say it's probably about 300 basis points, right? Which would be about 3% higher than whatever the risk-free rate is. So take the 10-year treasury is kind of what I use as that barometer. So if you could get, if treasuries are at 4.5%, it starts to get interesting, probably around that 7.5% mark. Obviously, higher is better. We've got some of our investments where we're in, well into the double digits. And that feels great, right? Because again, that on an ongoing basis continues to compound really well. But I think in general, high single digits to low double digits is probably squarely where most of our investments live in that yield range. And again, what you want to look at there is the durability of those cash flows, right? What can go wrong that offsets those or requires you to have to, put in further capital investment, or what puts you into risk from a threshold point of view if you have debt on the property, things like that. But I think that's probably the interest that, if you're high single digits, you're probably right in the strike zone there.
Got it. Got it. Do you ever place loans, or is it strictly an equity investment?
Yeah, at this point, we do mostly only equity. I mean, we've done a couple things when you're the size we are, we'll do other things, but I would say that's not our core focus. If we were, we would develop a very specific capability around that. It's one of the things we've looked at because there is a time and place that you want to be investing at different places in the capital stack, right? I would argue 2 years ago, 3 years ago, that was actually a pretty good time to be investing, I think, on the debt side of the balance sheet. Only because I think there was a lot of uncertainty, and I think you could get because there was a lack of liquidity in the market, you could get very attractive debt terms that still had very low risk associated with them and a lot of collateral. So that ebbs and flows, right, over time, and I think it's going to be it's very difficult to double your money in 3 to 5 years with debt. But again, if you can get into, a 5-year hold, an IRR on a 5-year hold project levels, that's about a little north of an 18, right? On what will get you to that number. In debt, we saw things approaching that or getting to that number for a while there. So there is a time and place when you want to definitely be playing in the debt area. We've chosen to play more prominently in the equity arena just because that tends to be where, by and large, there's more opportunities for us to get the kind of returns we're looking for. But there's definitely a time and place that investing on the debt side is very attractive.
Got it. And as far as the focus and the what Realm does, you're not necessarily taking taking funds from your customers as much as you're presenting opportunities and having a deal call where everybody invests and that gets fund a deal, and then am I understanding right, or is
That's exactly
okay?
right. Yeah, we don't take any funds up front from
Okay.
any of our investors. When there's an investment, we create a special purpose vehicle that's that entity that owns that asset directly, and then we actually fund into a property account that's going to be, just for that property individually. So there's no commingling of funds or things like that. I think that's part of the beauty of our model is that everything's on a standalone basis, and that's a beautiful thing in direct real estate because every property has its own business plan, right? So you want to make sure to the extent you can have things stand alone. I'm sure my accounting staff hates me for it, but it's one of those things where it does provide that flexibility and transparency to investors, which is so important.
Oh. Well, it's an interesting model. I mean, just the focus on the clients. I've always recognized if you can work with people that have money as opposed to people that are wanting money, it's a lot easier swimming when at least when you have a deal, you know it's going to get funded, as opposed to the deal that can't get funded kind of thing. So it's interesting. Hey, Travis, if we could, I'd like to shift gears here for a second. Um, by day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if we can avoid the risk. And if we can't avoid it, then we look to see if there's a way we can minimize the risk. And if we're not able to avoid nor minimize, then we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, uh, investors, the market, interest rates, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so, if you're willing, I'd like to ask you, Travis King, what is the biggest risk?
It's a great question. It's actually really hard to try to encapsulate it in one thing. So maybe I might give a multifaceted answer if that's okay with you. One thing I would say that is paramount in real estate, and I alluded to it earlier, is the only real way I know to lose money in real estate is to lever inappropriately. So leverage, at the end of the day, that's how you lose control of your properties, right? And that happens. So then you peel that onion a little bit and say, okay, well, how does that happen, right? How do you run into problems there? And I think there's two main areas that I would focus on as kind of subpoints. Number one is going to be making sure that you're checking your assumptions and making sure that they stand up in a lot of alternative scenarios you might not have considered, right? A perfect example was back in, remember during the housing bubble of 2008 when everything popped, they realized at one point that there was no way to even show, potential negative drop in housing values, right? That's a great example of just a glaring error of saying, well, you got to be able to test some of your assumptions. And I think you really need to beat them up and test them under ultimate scenarios that could happen. Black swans do happen, right? And I think that sometimes it doesn't even need to be a black swan. We've seen things where we've preached to folks over and over to say, in multifamily as an example, if you were to go through and change your rents just by 10 or 15% on a multifamily property. And then, the cap rates move, a little bit. You have cap rates move 50 basis point because the market's in a little bit of turmoil, right? And your occupancy gets hit by 5, 10%. Just all these things are fairly small changes. It could be 15 to 20% of the value of the property. So if you're buying something, that's very highly leveraged, you could find yourself in a very difficult position very quickly. The second thing I would say is be careful who you're doing business with. A lot of times, it really comes down to making sure you have the right partners. Some of the biggest problems I've seen happen are doing business with the wrong people, and I think that that's where you run into problem, regardless of what your documents might say. If you're not dealing with trustworthy people that are putting integrity first and foremost, that's an easy way to get into trouble. So eyes wide open on who you work with. Uh, do your background checks, talk to people, get references, referrals, move slowly. I think you do those two things together and stay conservative in your capital structure. You avoid a lot of pitfalls.
Yeah, I like both those. That's definitely the leverage and working with somebody you can trust. Definitely seen some bad conclusions on both those fronts. That's good. Hey, Travis, where can listeners go if they'd like to learn more or connect with you?
Sure. The easiest thing would be just to go to our website, which is Realm, REALM, LP, as in limited partner.com, realmlp.com. And we've got lots of information on us on the website.
Awesome. Well, Travis King, I cannot say thanks enough for taking the time to talk. I've enjoyed it. I've learned a lot and look forward to doing it again soon.
Thanks, Darren. I enjoyed it as well.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Networks, CREPN Radio. All right. I love your model, man.